Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have Gerard, Minack, and Ira Harris. Gerard has been analyzing, forecasting, and advising on financial markets since 1987. His focus is the fundamental factors that usually drive investment performance, valuation, currency, monetary policy, and the economic cycle. He retired from Morgan Stanley in May of 2013. He worked for Morgan Stanley as the global cross-asset strategist. Earlier in his career at ABN AMRO, he started Minack Advisors in 2013. It provides fundamentally based research on financial markets for institutional investors, hedge funds, family offices, and sovereign wealth funds around the world. And Ira's hedge fund manager, global trader in foreign currencies, bonds, commodities, and equities for over 40 years. He served as CME director from 1997 to 2003, and also a period recently. Welcome, gentlemen.
G'day.
Thank you, Richard.
Great. And just thought we'd begin with a discussion at the big picture level, and then we can zoom in for more detailed questions and analysis. Gerard, what are your thoughts on the global economy and the financial markets in general?
Well, I think this pandemic is potentially the catalyst for a major structural change. I've been a card-carrying secular stagnationist for 2 decades, even before Larry Summers popularised the term. I used to be saying to people that the world was turning Japanese. And I still think the underlying forces behind secular stagnation absolutely remain intact. But I think this COVID crisis is the catalyst for a massive policy change, a shift to fiscal dominance, that is, fiscal tools becoming the principal way that cycles are managed, with central banks just providing backstops to the fiscal authority. And if that's the way the policy framework is evolving, then that potentially brings the curtain down on secular stagnation. And that means that many of the most important investment trends of the last 4 decades, I think, will start to reverse. And the most obvious one is the secular decline in interest rates. So this has been a 40-year trend, so it's not going to turn on a dime, but I do think we're heading higher. And to benchmark that call, I think this could be the first cycle since the late 1970s when the cycle peak in the 10-year Treasury exceeds the prior cycle peak, something that, as I said, hasn't happened for 4 decades. And that means I think we end up with 10-year Treasury yields around 4% at the end of this cycle. To say that we end at 4% means that 4% ends the cycle. So I think this is a story only 2025, that sort of time horizon. But I do think the trends have changed, and that's massively important to investors.
Great, interesting. And your thoughts, Ira?
We have to ferret some of that out. The secular stagnation is, I certainly have not been in that camp as it's defined by Larry Summers. Yes, there are facets to it that are certainly right. But I think, as you know, I've talked about, and Louis Gavay and I've talked about, and I think is that there is a more than cyclical change afoot. I think that China impact, and I think that we call secular stagnation, a lot of it has been the result of the massive influence of the unleashing of China on the global economy and all of its huge amount of industrial capacity, which has kept prices down. And when I put on my Marxist hat long ago, the arbitraging of wages with the free flow of capital has done a great deal to create that situation. Now I'm in the camp. Now I'm not in any camp, but I believe that China, as Michael Pettis has certainly been talking about for over a decade already, when it moves into becoming a more domestic consumption-oriented economy, that is going to have a major structural change on the world, because it's going to stop putting downward pressure on prices. Now, yes, you can argue that India and some other rising emerging markets will supplant it. But I think that the initial, and when I say initial, I'm not sure how many years we'll live through this, is you'll get a rising yuan, because a strengthening currency as you're building and empowering your middle class is necessary. That I would argue that the United States post World War II, in the Bretton Woods era, a strong dollar certainly empowered and aided and abetted the U.S. Middle class. So I think we're going to see that. And I think the influence on the global economy is going to be something that we will watch and hopefully be able to make profitable trades and investments from.
I mean, I certainly think China was an influence in this sort of trend decline in rates, and arguably globalisation is the only cause or factor behind secular stagnation that's probably run out of puff. But the fact is that the great deceleration in rates and inflation and nominal growth predated China, and to the extent that globalisation, in a sense, exhausted itself a decade ago, because global trade volumes relative to GDP did peak around the GFC. The pressure down on rates continued. So, look, in a way, we can discuss the causes. I think that the shift to fiscal means that we overcome, or fiscal provides an antidote to those underlying causes, which means that we can see a structural change in the rate story that's dominated for 40 years.
Well, there's no question. I think that's right, especially as the fiscal tries to reassert itself and tries to supplant, as Chuck Schumer said, the Fed being the only game in town. I think it's a welcome relief, but the importance is how the central banks are going to exit stage left. Will they be followed by a bear? To paraphrase Shakespeare, that to me is the uncertainty. And will our central banks, because of their enhanced influence on the entire global system, do they have the intestinal fortitude to leave graciously and get out of the way and let other forces operate? And I think that's what's going to be the biggest aspect of the global system over the next 5 to 10 years.
Can you elaborate, Gerard, on your view of the shift in fiscal policy? Is that something jurisdictional or global? And what does that mean for investors?
Well, look, it's been led by the developed economies, and one of the remarkable features of the current reflation is how the leadership is diametrically different to the recovery coming out of the GFC. Coming out of the GFC, and I was at Morgan Stanley at the time, my then colleagues estimated that the total Chinese stimulus in 08-09 was around about 8.5% of, now wait for this, 8.5% of global GDP. I mean, it was massive. Well, we know the developed economies very quickly flicked the switch to austerity once we escaped the GFC. This time, China's doing very little at the margin, and the stimulus is being led in the developed economies and being led by the US. The IMF estimates that the total fiscal spend in the US now adds up to around 30% of US GDP. US GDP is still a quarter of the global total, so that amounts to 7.5% of global GDP, so not dissimilar to what China did in the GFC itself. So we've got this amazing about face. The US is leading, but the US is not alone. we've also seen sizable fiscal stimulus in other important developed economies. And what that's done is it's turbocharged the recovery. Now, look, policymakers are always willing to run deficits in downturns. The key test of whether we're moving to a new era is the willingness to run deficits through the expansion. The deficits don't need to be as large as what we saw last year or this year, but we need to avoid a quick switch to restraint. So packages like the recently agreed infrastructure spend in the States is consistent with this view that the foot's going to stay on the accelerator. And if that happens, it means we're going to have a stronger cycle, certainly a stronger cycle than what we saw in the aftermath of the GFC. But what it means for investors, well, there's a number of things, but one thing I would emphasise is in the post-GFC cycle, with fiscal policy gone AWOL, monetary policy was the only game in town. We very quickly hit the zero bound in most developed economies, and so central banks switched to unconventional tools, notably QE. Now, they argued that QE was going to operate through three channels. The first was flattening curves, and that would hopefully lead to higher demand for credit. Well, that didn't work. They flattened the curve, but we didn't get the credit pickup. The second channel, which they only spoke of in a soft voice, was currency depreciation. But of course, if everybody's doing QE, you don't depreciate against anything aside from gold, which is what we saw. The third channel was wealth effects. And all wealth effects is if I can make you feel richer by lifting asset prices, hopefully you'll save a little less. Now, as it turned out, that didn't work, but let's just focus on what it meant when central banks were relying on financial markets to be the principal channel for their policy to stimulate the real economy. No wonder they were so hypersensitive to any turbulence in markets, because a down market effectively they saw as a blockage for their stimulus. This time is very different. No one's relying on wealth effects at the moment. The stimulus is coming via fiscal. And I think one upshot of this is central banks will be far less sensitive to turbulence in financial markets. That doesn't mean they're going to be gratuitously looking to bring them down, and they still will read financial markets for signals on the real economy, but you're not going to see, in my view, the hypersensitivity of central banks to a down day on Wall Street. Put another way, I think in this new environment where fiscal policy is the main driver of stimulus, the Fed put the strike price has been reset at a much lower level. And I don't think investors appreciate that. That will get tested when we get some turbulence, which, I think we'll get a correction in the next few months. But I think the real risk to markets is going to come late 2022, perhaps 2023, when we get a second more serious wave of inflation, and that's when this thesis will get tested. But what I'm expecting from this distance is that central banks will be far less responsive to turbulence in markets than we saw in the aftermath of the GFC.
Mm-hmm. Interesting. And your thoughts, Ira?
Well, there's a lot I agree with there, and I think that's the test will be, and I don't understand what they're waiting for, is that the Fed is going to have to go to yield curve control if that is right, because the emphasis is going to keep on the long end suppressed, and if the curve flattens because the short end yields across the globe head up, 50, 100, 150 basis points, it's not going to be a terrible thing. It will be a difficult thing from a geopolitical perspective around the globe if the curve steepen and the central banks do nothing, because then the cost of all this fiscal activity is going to start to result in in political choices, especially you look in the U.S. Once you start hitting discretionary spending programs because the cost of financing the deficit were to rise fairly dramatically, you enter a whole new realm, and if there's one thing that we know and we've seen, that leadership at the Fed runs as can be expected, because most academics are cowards by design. I'm sorry if I'm stepping on anybody's toes, but that's a fact. I'm coming from somewhat of academia. I've seen it and the way that they do battle. But listen, Bernanke made a huge, disastrous error by cowering in the face of the so-called taper tantrum. That he just let it run its course. I think the Fed and other central banks would have been in a far better position. Now they're afraid of their own shadow, and that's a terrible thing. Powell did it wrong because, as Druckenmiller talks about, that double shotgun approach was a disaster. It actually blogged about it long before, that do one, do the other. Doing both would create too much uncertainty and unease in the monetary system, and that right. And then they became too quick to recoil from any of those decisions. So if you tell me now, it'll be to me very similar to what happened in the United States after World War II, when they had incurred so much debt to fight the war, and they had to keep debt, the interest on the debt artificially low in order to pay it off. So that's what they did. So therefore, we had yield curve control, which caused a lot of angst at the Fed, and then eventually had to be resolved with the accord. But that's what I will be looking at. If the curve were to flatten fairly dramatically, with the long end, with the short end rates rising and the Fed controlling the long end, well, I think it'll be not disastrous, but it will hurt the dollar. But softening the dollar while you're trying to get global growth going is not a necessarily bad thing. So I just think that's where we're going to resolve the issue, and the yield curve is going to become the paramount barometer of what's to take place for the next 5 to 10 years.
You see,
I see things.
Yeah.
Sorry, I was just going to say, I see things just a little different, because I absolutely agree that the dynamics of debt are problematic, and yield curve control was one way they sought to grapple with that after World War II. And then when the Fed said we're not going to keep a lid on rates anymore, they moved to financial oppression and forcing other people to hold treasuries. I think the good news is now we don't need to resort to either of those techniques, because we've got QE. And effectively, when you've got this high leverage, someone has to take a hit, and it's the central banks that have put up their hand. And to show you how this works, let's go to the poster child for high debt levels, and that's Japan. Now, Japan's gross public sector debt to GDP is around 250%. So you would think that if JGB yields go up, the Japanese government deficit's going to blow out. Well, the public sector also has some financial assets, so that means its net debt is down to about 120% of GDP. Once I take account of BOJ holdings of JGBs, the net exposure of the fiscal authority is about 18%, 18% of GDP. In other words, if JGB yields were to go up, yes, debt service payments would rise, but largely those payments would be to the BOJ, which presumably then repatriates them back as profits or dividends to the fiscal authority. So I think that the need for financial oppression is much less pressing now in a world where central banks have undertaken massive QE, and that's the way we wriggle out of this. It's the central banks that effectively sit on these uneconomic treasuries. And of course, the treasuries that these central banks have bought and is sitting on their balance sheets will never, ever, ever go back in the hands of the private sector. These balance sheets are lobster pots, easy to get onto, but impossible to get out of.
And the article that you wrote recently on the Swiss publication, The Market, or an interview thereof, you mentioned the idea of potentially ending up with unacceptably high inflation. Can you elaborate on that? Do you think that is a possibility?
Yes, but I need to put that in context. By unacceptably high, I mean, uncomfortable to investors now that have become accustomed to low inflation. I'm not at all signalling the risk of going back to 70s style inflation, let alone any sort of hyperinflation. I mean, the story's fairly straightforward to me. We have enormous amount of stimulus in the system. Moreover, we've got central banks that have told us that they will not be preemptive this cycle, and that effectively guarantees an inflation overshoot. And I think they may, that is, the central banks may be a little bit too cute, believing that they can achieve a modest overshoot. So I think at the end of this cycle, we could end up with inflation, core inflation, peaking at 3-4% in the States and being quite sticky at those levels and requiring rates to go up to quite uncomfortable levels. That's a story, I think, for 2025-ish sort of time horizon. The one thing I will say about the inflation story is I do definitely see it coming in two separate waves. I think what we're now in the midst of is this first wave, which is almost solely due to goods sector inflation. I'll be honest, it's taken me by surprise how much the factory gate inflation, and you always see factory gate inflation in a recovery, how much it's been passed through to consumer prices. Normally that doesn't occur. And I think what's been different this cycle is that the pandemic was both a demand shock and a supply shock. The supply disruptions have driven inventory levels to record lows. If you look at US retailers, stock to sales ratios, they are at all-time lows. And that's given good sellers a temporary bout of pricing power. And that's been most clear cut in autos. And that's been the reason that we've seen this, from my perspective, larger than expected lift in goods prices. And just to give you a sense of how important that's been, core inflation in the States now running at 3.8%. If I pull out the contribution from autos, we're down at 2.2, which is exactly where we were pre-pandemic. Now, this is transient. I mean, there's no way we're going to see these prices stick. Car rental prices up 110% over the last year. This will at some stage turn around. And I think bond markets are getting a sniff of that, which is why we've seen them move sideways to down for the last 2 or 3 months. It's the second wave of inflation, which will be led by services and shelter, which will be the persistent big guns in the inflation battle that central banks will be impossible to dismiss as transient and will force them to respond. And that, to me, is what is the big risk to investors. I think we start to get a sniff of it next year, but it really becomes a major issue in 2023. So it's that second wave that's going to get us. I don't think it's a story for this year. I think this goods-based wave of inflation is transient. But don't get fooled. We're going to be in the eye of a storm, and the second bout of wind is going to come through in 18 months, 2 years' time.
Okay. And your thoughts, Ira?
Well, this is a good, interesting discussion because I'm not in disagreement of what Gerard says, but I have a couple of questions. So if we maintain QE and the central banks, will use the Fed here on this one, although there's certainly a cacophony of central banks. So you buy your bonds, you collect the interest, and you turn the interest over to the fiscal authority, right? That's how this operates.
Yep.
But then we've created a perpetual money machine. And then my attitude is, well, why do we have to do anything? There was never, then the MMT crowd is right. And I'm not going to say that they are, because when I read the MMT crowd, their ultimate bottom line is that the electorate is responsible. And if things were running out of control, they would vote to raise taxes to curb the excesses in the system. Well, I give that as much possibility in looking at the United States as the landing of UFOs on the White House lawn in the next week. So I don't really give that, because that's always bothered me. What have we done to create a perpetual money machine? So I raise that issue. And number two, when we start comparing to Japan, I run into a problem. Number one is when Japan went down this rabbit hole, 97% of the debt, of Japanese debt, was owned by Japanese domestic investors. That is certainly not the case in the US, who is the world's reserve currency. And when you keep approach that, and you are, and I would say this, Japanese investors in that case never endured negative real yields. Well, let me step back. By 1994, I would say 95, they certainly were getting positive real yields, even with JGBs at 30 basis points or 20 basis points or 40. There was a real yield of almost, I believe, 2%. We are operating now at negative real yields of 2% or more, depending upon which measures of inflation. And in a world where the United States depends, because of its reserve currency status, on the savings of the rest of the world, which is a large part of the secular stagnation discussion, how long will the world continue to put up with negative real yields? Or when will they desire or demand? Desire is not the issue. When will they demand real positive yields, and how high will the rates go, and what will be the economic fallout from that? So this is a very important discussion. I don't have the answers. What I am plagued with a multitude of questions. And when I compare Japan to others, to me, the Japanese comparison falls flat, because first of all, the Japanese have a very high savings rate, or they did, especially when they embarked upon this terrible economic stagnation, and the makeup of who owned their debt played a very important role. So, I get more worried when the opposite is taking place, and you're the world's reserve currency with all the responsibility that requires. So I'm more nervous in this one than seeing the fallout that we saw from the Japanese. And I really worry that perpetual money machine, I don't know, it's really more a question I'm posing than anything else. How do we sustain that? And if it's so easy to sustain, why don't we all just sit back and just enjoy ourselves and just, throw debt to the wind, let the Fed buy it, and just keep remanding the money to Congress?
Yeah, there's a lot there. Firstly, on the first point, the perpetual money machine. I do agree with the chief tenet of MMT, which is the real constraint on public finances is the capacity of the economy, not any arbitrary concern about debt and deficits. But like you, I'm sceptical that you'd ever expect politicians to increase taxes when the time for restraint comes. So I think it's a bit like driving a car where you've got two people with hands on the wheel. One person's got control of the accelerator, and that's the fiscal authority, and the other person's got control of the brake, and that's the central bank. Because when it comes to monetary policy, I think we're in the stage now where monetary policy is hugely asymmetric. It's very ineffectual as a stimulant, while fiscal policy still works. But monetary policy absolutely is effective as a restraint. Now, this is not necessarily unprecedented. I mean, we've had plenty of episodes where fiscal and monetary policy's been at cross purposes. I mean, the most recent was Mr. Trump's fiscal stimulus, which came very late in a cycle with very low unemployment, and the Fed then needed to tighten. Now, we can debate whether the Fed really needed to tighten or not, but the fact was there you had the fiscal authority loosening policy and the central bank disagreeing and saying we need to tighten it. So I think it's not a perpetual money machine in the sense that there's no limit. The limit's the capacity, but I share your cynicism about relying on the fiscal authority to impose restraint. I think that will be the job of the central bank, which is why I can see rates going up to a new cycle peak, surpassing the last cycle peak. I don't want to get too much into the weeds about the Japan versus US story. The only point I'd make is that specifically in terms of the cost of servicing the debt, I don't think it's that pertinent a point who owns the debt. You've still got to service it. There may be other circumstances where the point that a lot of JGBs are domestically held does matter, but in this context, I don't think it does. The other point I'd mention about treasuries is, what's the real yield on a treasury? I mean, there's several estimates. If I compare the spot yield now to the trailing CPI, it's horribly negative. If I look at the forward-looking real yield by looking at the index linkers, it's a little negative, but not too bad. But what about if I look at the real yield from the perspective of, say, a Japanese buyer? Because a Japanese buyer isn't going to use the US CPI as the deflator. They're going to use the Japanese CPI. And so what we've now got a situation is if you're a Japanese buyer purchasing a 10-year treasury, hedging out the funding and FX risk, you've now got a yield pickup of over 100 basis points. And that's pretty much an attractive real yield to a Japanese buyer. It's certainly a lot more attractive than their own JGBs are. And as a result, what we've seen over the last couple of months is this gushing inflow of foreign money to buy treasuries, because guess what? From a German or a Japanese perspective, hedging out FX risk, these now look attractive real yields. So I going down the path of sustained fiscal policy, I can't deny it, will put upward pressure on yields, but I do think there is this piece of elastic between long-end yields in places like Europe and Japan attached to the Treasury market, and that will prevent a really sharp escalation for a while.
No, I agree with those. Those are really good points, especially on the Japanese investor being able to hedge itself out through the FX swap markets. Absolutely. But that raises another issue. When is Japanese investor buying of foreign assets deemed to be currency manipulation? Because we're going to run into that. I just don't know when. Because the yen has been the weakest currency of the majors for quite a while. I mean, we've seen weakness, and a lot of that is due to the outflow of money of investment funds from Japan to the rest of the world. In fact, as I blogged about last night, the recent release of the Japanese government pension investment fund, which returned 25% over the last June 30th to June 30th, and a real amount of $329 billion in profits for the year. Now, granted, they lost a little bit, and they break it down. And the only place where they lost money, of course, was in the JGB market. In their foreign bonds, I think they made 1.7%. And the rest of the earnings were in Japanese equities, which they buy along with the BOJ, and foreign equities. But just like the Swiss National Bank, if the rest of the world says, hey, your actions are keeping the yen under pressure and attaining a competitive advantage, when does that get addressed by the authorities, and that come into play? And how do we answer that? I mean, these are things that to me, are potentially very destabilizing elements in that. And yes, but there's a lot of Japanese investors who don't hedge their currency risk as much as does get it. There's a lot that does not get hedged as they're pursuing nominal yields, as Gerard, you rightly say, because what they're getting, and based on comparative rates and nominal rates around the world, they deem it worthwhile. And right now, they haven't been punished. What the yen, as we're looking today, the yen is still 110.60. Put up. I'm gonna go to the charts, and we've been in this range between 102 and 115 for 4 years. So it's been for a relative basis for Japanese investors, it's been pretty good. But how long will that range will hold? And that's a very important element to that. It's an important element across the entire board, because every central bank except the Fed, although we don't know because the Fed will never say it, but every other central bank talks about the value of their currencies. The RBA always has a sentence or two about the current status of the Aussie. The Kiwi, same thing. The Canadian, the same thing. The Brits, the same thing. Even the ECB, and we certainly know the Japanese. So everybody wants to talk about it, and we all can't have it. We all can't be with a weakening currency, although Gerard absolutely said it right, against gold, yes. But as far as trade and economic outcomes, somebody will always bear the burden eventually. Not everybody, even though every central bank seems to want to believe that they can, but that could, of course, change in a minute. And if you're really looking for global growth to take off, I think a weaker dollar really does a lot more for the world than a stronger dollar does. Only because of the huge amount of emerging market private and public debt priced in dollars, and when the dollar goes higher, that acts as a restraint on global growth. So a lot of things here, and I'm glad we're talking about them because I don't know the answers. I'm looking for investable opportunities in seeking the contextual basis of these questions, but I don't know the ultimate outcome. As to quote Louis Gavet, my clients don't pay me to forecast; they pay me to adapt, and I think that's what we're busy trying to. And I'm trying to adapt. I can't. Gerard, in many ways, I believe is absolutely right. But the tell will be for me how I adapt to making money in that type of environment and reacting when things aren't playing out as we expect them to.
And speaking of Japan and emerging markets, in that article referenced earlier, Gerard, you mentioned that emerging market equities look cheap and have operational leverage, but your preference is to play the cycle with Japan and Europe over emerging markets. Can you elaborate on that? And which emerging markets do you like as well?
Well, let me make a mea culpa up front. That call has not worked out. Japan's been the laggard for reasons I'll explain. But look, when the reflation trade sort of loomed into view, as we saw the stimulus wound up through last year, I was arguing to people that you could play that reflation trade, via three sort of spaces, so to speak. You could either have sector tilts, like tilt to financials and industrials and materials, and downweight your tech and your healthcare, or you could have style tilts, which would largely be out of growth into value, or you could have country level tilts out of the US into EM, or my preference was Japan. Well, as they say, 2 out of 3 ain't bad. The first 2 ways worked. The country tilt certainly did not. And what wrong-footed me was that exceptional leadership in an economic sense from the US. It's made this recovery very different to most global recoveries. And the US has, in a sense, led on 2 fronts. It's delivered larger stimulus than other economies, and it's been more successful rolling out vaccines, which has allowed for a swifter reopening. So the US has continued to outperform. Europe is next in the race. Poor old Japan's in the caboose. It's mucked up the vaccine rollout. It's not done a lot of stimulus. So unfortunately, Japanese equities have lagged, even though I still think they've got a number of attractive properties. So let me talk about why I like Japan and what I now think we need to see to make Japan outperform. My starting point with Japan is I do see structural change. Japanese corporates historically have been horrible allocators of capital, and that was reflected in return on asset numbers that were well below their global peers. In order to not look so bad on an ROE basis, they deployed a massive amount of leverage. So through the 80s, Japanese corporates levered up to frankly unbelievable levels across the index. Net debt to equity got to over 100%. By reference, the rest of the world now, which is also levered up over the last decade, is sitting at about 55%. So twice as levered as corporates are now. But what's happened since is the ROAs have improved. Japanese corporates have delevered. Japanese non-financials are now less levered than their global peers. Profit margins have improved. Earnings over the last decade have risen faster than global peers. So these are all fantastic ticks in the box. The fact is, however, it's not been reflected in relative performance. And so Japanese corporates have continued to derate. Now, initially, if you go all the way back to the bubble peak in 89, I mean, the Japanese equity market was on nosebleed valuations. I like watching these so-called cycle-adjusted PEs or Schiller PEs. At the top of the tech bubble, the S&P 500 in 2000 was on a cape of 45. Well, at the top of the Japanese bubble, the Topix was on a cape of 100. I mean, it was just an order of magnitude more ludicrous. But it spent the last 3 decades deleveraging, and now Japan trades at a valuation discount. So I was looking at a market last year that had structural improvement, had delevered, which is important to me in a world where I think rates are ultimately going up, had delivered on better earnings growth, and was now trading at a discount. And frankly, when I talk to my clients globally, had fallen off most people's radars. So it wasn't quite as contrary a trade to be long Japan as it would have been to be long Europe, because people actively hated Europe. But certainly you couldn't say that people were overweight Japan. So I was bullish. The thing is, if you want to buy a cyclical market, it's helpful for them to have a decent cycle. And that, for now, is where I think Japan has snatched defeat from the jaws of victory. They've fluffed it. Japan is badly lagging the global recovery. I think those promising fundamentals are intact, but I've just got my timing wrong. And now, in a sense, I think there's going to be better timing. I need clearer evidence that the Japanese recovery is actually gaining traction. And for now, if you want to play this reflation trade, well, the first thing I'd say is I think it's probably a cleaner way to play it by sector tilts than country tilts. But if you want to focus on countries, then I'd actually focus on Europe and, as we look into next year, selective parts of EM. because EM has also been lagging developed markets. So I've changed my views a little since that article was published. And as I said, I got prematurely excited on Japan, and it's not paid off, unfortunately.
Mm-hmm. And your thoughts, Ira?
Well, no, I think that's a great analysis. And one thing that I keep looking for, because as I get bullish, the Japanese equity market, is the Japanese banks. Because, they were what everybody wanted to mimic in the late 80s and early 90s. And that was a big part of the push to get rid of Glass-Steagall, because the U.S. money center banks were complaining that they couldn't compete with the massive strength of the Japanese banks. And the Japanese banks have, and I can attest to it, are probably the worst investment over the last 25 years that there's been in the world. If they didn't pay dividends, they'd be, for sure, without question, the number one worst investment. But if Japan, which is a story that keeps waiting, from people like Daniel Loeb and others who are trying to get on the corporate boards and private equity moving in, the Japanese banks have to start to reassert some of their ability around the globe. And God, they are so pathetically cheap and under-owned and underappreciated that until they really start moving, there are Japan has so many great companies. But I still keep waiting and watching for those banks to begin moving. I think it would be a really good indicator of Japan actually starting to rise up out of that system, to rise up out of its out of the doldrums and get moving. Because again, it's not for a lack of capital. So I agree. Gerard's point, I think, is very, very well taken. I think Japan is very important. I think they're well positioned around the world, and they have a weak currency in which to deal with. I mean, especially the weak yen really provides Japanese corporations and industry with a great advantage versus the Germans. And we know how important China is for the German markets. But when you look at euro yen, which is now even the euro yen as we would, if it was a Deutschmark, we would say it's highly undervalued, but it's not a Deutschmark. It carries the weight of the rest of Europe for Germany. But that is a huge advantage. And you can especially see it. One of the charts that I love to watch is the yen yuan. And when we look at that, we have just made, we have been back to an interesting level, which I've talked about, but we can go back to 1998, where we just hit that level at 17.5 yen to a yuan, which was the level it was at in June, July of 1998, which was such an important piece of the foreign exchange world, because that's when the Fed intervened to strengthen the yen because it had gotten too weak, and the Chinese were badgering the U.S. when Bill Clinton was going to Beijing in June of 1998. We're back at that level. So the yen is sitting in a very, very powerful position to take in a competitive position, I would say. So I'm in agreement with Gerard. I think that's very important.
Just coming to a time constraint here. Last question. Gerard, what are your thoughts on commodities, especially being from Australia?
Look, I'm upbeat. I'm probably more upbeat on the commodity producers than the commodities. Everywhere I look in the developed world, the demand for stuff seems set to be strong. and that is autos, and demand for autos is very strong. It's just the supply's got to catch up. Housing is doing very well everywhere. Governments are redirecting their fiscal stimulus from last year, which was overwhelmingly cash transfer payments to households and small business, to increasingly spending on infrastructure and climate mitigation. And even the leading indicators of corporate capex are bouncing aggressively in a number of places. So this is all overweight demand for, as I say, physical stuff, for commodities. On the other hand, China is not setting the world on fire. I don't think it's going to have a hard landing, but it's just going to plod along rather than being a big accelerant. So net that paints a picture of moderate to slightly positive demand for commodities. But what impresses me is the supply side. Most of the big commodity suppliers completely screwed up the last cycle. They massively built out capacity in the just prior to the GFC, and then in the immediate aftermath as Japan bounced back. And they brought a whole lot of extra supply online just as the bottom fell out of the global cycle. That destroyed their returns. And I think every CEO, CFO at these big firms still has the scars of that ill-timed expansion, and they will not be expanding capacity anytime soon. So I'm impressed by the supply side discipline. Mm-hmm. I think they're going to make good money over the next few years, and they will be returning that to shareholders as dividends. They won't be spending it on capacity. So I'm quite positive.
Mm-hmm. Great. And your thoughts, Ira?
Well, I certainly agree with that, because we know that the miners, and Gerard being from Australia certainly knows that they're like the telecoms. When they get too much money in their hands, boy, they sure find ways to waste it on ridiculous acquisitions or other things. So I think that's right. I think they're more disciplined now. But I'm bullish still, and I'm not one who, the Fed tightened, the reflation is over. I think that's a falsehood. Again, I believe that China, and I can watch the yuan to attest to it, because the yuan started rising long before the global economies, and I'm talking about the US and everybody else, long before the vaccine. The vaccine didn't become until November, but you had copper, grains, iron ore, all types of raw materials were rallying well before the onset of that. And at the same time, the yuan was strengthening too, which flew in the face of everybody's model designs, which, when the global economy slows, China will weaken its currency in an effort to gain whatever competitive advantage. But we didn't see that last year. In fact, the opposite took place, and copper and other things started rallying well before the global recovery. So I think that there's a dynamic change, and I think that China uses a stronger yuan to stockpile. I think they stockpiled a great deal of iron ore, copper, grains, and why not? Because if they have $3 trillion, so if you were to take 10% of that $3 trillion and start putting it into buying things that you actually use, you are doing yourself a favor, rather than buying treasury, 10-year treasuries that have a negative real yield. So you can diversify yourself, and I think we're seeing that. And I think that's one of the hugely important dynamics that is going to change the entire global financial system. And as I wrote last night, why shouldn't they do that? Why shouldn't large nation state actors like China, Russia, Brazil, and others, why aren't they playing in the commodity markets and the raw material markets in the same way, and affecting prices in the same way that the Fed tries to dominate and control the pricing mechanism in global debt markets? Why not? And I think we're now in the thrust of starting to see that. And I think it's going to play out very positively for raw material producers.
Great. It's been an insightful discussion. Gentlemen, how can our listeners learn more about your work? Gerard?
They can just send me an email, gerard@minackadvisors.com, or on Bloomberg, just shoot me a Bloomberg message.
And Ira?
Notes from Underground, and you can find me doing Financial Repression Authority podcasts like this one, and this is a pleasure because, you know, it brings together. I thoroughly enjoyed this, and we don't always have to agree in full. That when we ferret out some of these discussions, that you learn more than if that if everybody just says, well, this is the way it is. No, I think this has been a great discussion. I've learned a lot myself, so I'm glad, and I think people. I hope that people avail themselves, because you will learn things here that you don't ordinarily see in the arenas where everybody just sits there and echoes what they heard. This is, I think, very useful. It's useful to me.
No, it's been great. I've enjoyed the chat. Thanks for arranging this, Richard. Most appreciated.
Great. Thank you so much. Take care, gentlemen. Thank you, Ira.
Yep.
And Gerard.
Yep.
Thank you.
Okay, see you. Stay safe.
Right. You will.
Thanks.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.